Hello, everyone, and welcome to our presentation. We're from the Group 5. So, as you can see on the screen, our assigned topic is Chapter 9 Agency Conflicts and Corporate Governance. So, in my presentation, I'll be focusing on traditional approach to agency conflicts. The agency theory is used to study the structure of compensation contract that principals offer to agents engaged to act on their behalf. In the corporate governance setting, shareholders are the principals, and the board of directors is charged with representing the interests of shareholders, and the firm's manager are the agents. Rational principals offer contract to rational agents that combine positive rewards and penalties, that is so-called carrots and stick, with three goals in mind. The first goal is to offer the agent a contract that is at least as attractive as the agent's next best alternative, in order to induce the agent to principal. This goal is known as the participation constraint. The second goal is to set the differential between the carrot and stick components so as to induce the agent to represent the interests of principal. This goal, the alignment of manager interests and investors' interests, is known as incentive compatibility constraint. The third goal is for the contract not to be unduly generous to the agent. This goal is known as non-overpayment constraint. Next is paying for performance in practice. The evidence about how well the traditional approach to agency conflicts applies in practice is mixed. The most influential academic studies on executive compensation conclude that CEO pay varies far too little to be consistent with traditional theory. These studies, published in 1990, indicate that the most corporate boards do not structure salaries, bonuses, and stock options so as to provide either large rewards for superior performance or large penalty for poor performance. Executive pays has a feature to narrow a carrot stick differential, resulting in low variability in respect to corporate performance. The frequency with which CEOs are dismissed for poor performance, and that is resulting in low variability. And corporate stock options do not apply to play a major role in aligning the interests of executives and investors. Some evidence points to the relative strength of shareholders' right as being key. Low variability in finance is most commonly applied to variability of returns, wherein investors prefer investments that have higher return with less variability. Dismiss. CEO of companies with average return are more likely to leave their job than CEOs in poor performance firms. Stock options. Firms offering stock options to their employees perform better than those that do not. Shareholders' right. Firms with stronger shareholders' right are associated with higher firm value, higher profit, and higher sale growth, lower capital expenditure, and lower corporate accusation. Executive compensation display too little variability in respect to pay for performance, insufficient dismissal, and excessive payment. Directors are overconfident in their ability to structure incentive appropriately without overpaying executives. Directors' tasks are made more difficult by the overconfidence of executives. Overconfidence among directors and executives. Overconfidence on the part of directors will lead them to underestimate the extent of both traditional agency conflicts and behavioral biases on the part of executives that contribute to those conflicts. Overconfident directors will be inclined to think that they can do better job of addressing agency conflicts than they do. In consequence, overconfident overconfident directors will be prone to approve compensation policies that exhibit insufficient pay for performance and that overpay executives. An important facet of overconfidence is self attribute error, the tendency for people to take credit for positive outcome and to blame others or bad luck for negative outcomes. Another important facet of overconfidence is the better than average effect. The better than average effect involves more people viewing themselves as above the median in ability than below the median. Next is psychological phenomena. A key lesson from the previous section is that arrangements between principal and agent often fall short in respect to paying properly for performance and avoiding overpayment. The point of this chapter is to identify the psychological factors that lead to this state of affairs, such as overconfidence, prospect theory, risk aversion, time preference, and relative income. From the mouths of directors, in 2001, Fortune magazine interviewed a group of high-ranking corporate directors in respect to executives' compensation. Interviewees' candid remarks characterized directors as being overconfident in their ability to oversee director and deal with compensation consultant, which one interviewee described as amateurs competing against professional. In addition, interviewees point out that the director have difficulty dealing with managers' tendency to resist a low reward for poor performance but seek a high reward for good performance that stem for external factors rather than their own efforts. Psychologically, these features corresponds to a combination of self-interest and self-attribute bias. Self-attribute bias is the tendency for people to take credit for positive income and to blame others or bad luck for negative outcome. Next is prospect theory and stock options based compensation. There are three important behavioral phenomena associated with stock options that being used to compensate employees, especially executives. First is excessively optimistic. Overconfident employees will overvalue their firm, thereby overvaluing the stock options they are granted. Second, many employees have a preference for the small probability of a large payoff, what some called are casino effects. Third, stock options compensations increase the propensity to engage in accounting fraud. Next is prospect theory and stock option based compensation. There are three important behavioral phenomena associated with stock options that being used to compensate employees, especially executive. First, excessively optimistic. Overconfident employees will overvalue their firm, thereby overvaluing the stock options they are granted. Second, um, many employees have a preference for a small probability of a large payoff, what some call a casino effect. Third, third, stock option compensation increase the propensity to engage in accounting fraud. Overvaluing options, the evidence suggests that firms pay their employees in options whenever employees are excessively optimistic about the prospect of their firm. Moreover, when upper level executives believe that their firm's stock is overvalued, they appear to grant more options to rank and file employees. Next is risk aversion and impatience. In the first part, I said that makes the point of the incentive compatible contracts often requires that agents be risks, and therefore, because of the participation constraint, all else being the same, such as contract required, the more risk averse agent need to be better compensated than less risk averse agent. The all else in the last sentence includes psychological phenomena such as excessive optimistic and overconfidence. Certainly, these phenomena can counter and even offset the impact of risk aversion. The behavioral approach distinguishes between mild version and extreme version of psychological phenomena, such as um, excessive optimism and overconfidence. Risk-averse managers who exhibit mild version requires less performance-based compensation to overcome their innate aversion to risks. However, managers with extreme versions prefer greater performance-based compensation. Next is relative income. People are competitive creatures who cares when they place in a social pecking orders. Survey evidence documenting levels of happiness find that for the most part, it is relative income that determines happiness, not absolute income. Of course, for people living in poverty, absolute income is indeed important. However, once some income threshold is reached, it is relative income that dominates as a driver of happiness. Indeed, neuroscientific research finds evidence of biochemical processes in in our nervous system and testosterone level that relate to relative positioning. And there is also evidence indicating that relative positioning and health are positively related. So the academic literatures contains long-standing survey evidence about the importance of relative salary within firm. So this evidence suggests that how a firm's employees views their own salaries depend to a great extent on what they think other people in firms are earning. Most importantly, perceptions of relative positions have large effect on morale, having to do with feelings about status and respect. So the comment of the compensation consultant discussed earlier include comments about relative incomes and morale. These comments point out that the paying of large bonuses to top executives not only reduce morale in organization, but also reduce employees' willingness to share with management information about problems and possible solution. Next, I'll be focusing on incentive, accounting, auditing, and psychology. Earnings management. mm, The evidence suggests that the firms take psychological factors into account when managing earnings. To do so, they appear to use heuristic involving a prioritized list of threshold reference points, namely positive earnings, past record earnings, and analyst expectation. In this regard, whenever possible, manager will use discretionary items to meet or exceed the highest possible threshold. As a result, um, the distribution of announced earning per share or EPS tends to cluster around reference points from above, especially at zero, but not from below. Such behavior is consistent with the idea of catering when investors exhibit loss aversion in connection with these reference points. Next is auditing. Mm, Both loss aversion and aversion to assure loss are central feature of prospect theory. According to prospect theory, people behave as if they seek risk when facing the prospect of what they perceive to be a sure loss. Aversion to a sure loss can wreak havoc with a traditional incentive, normally relied upon to resolve agency conflict. So, in theory, auditing firms serve the interests of investors. Auditors examine the financial statement of firms and decided whether or not they can offer clean options on the integrity of those statements. Auditing agency conflicts and prospect theory. Auditors are vulnerable to being bribed by unscrupulous firm in order to issue clean options. Audit firms are partnerships, not corporations. Traditional views holds the auditing firms have reputation for integrity to protect. Policy two times. So, in 1997, the partnership at Andersen Consulting voted to split off completely from Arthur Andersen to become Accenture. In the wake of their departure, Arthur Andersen instituted a policy known as two times. Under two times, for every dollar of auditing work, partners were required to bring in twice the revenue in non auditing work. Conflict of interest. Arthur Andersen. Consulting division became much more profitable than the auditing division. In 1989, the consultant managed to alter the profit sharing rules in their favor. The change in sharing rules left the auditors lagging behind those of attorney, investment bankers, and especially consultants. At the time, Arthur Andersen decided to take on the roles of both internal and external auditor. Arthur Levitt chaired the Security and Exchange Commission, and he raised a concern that practice of this sort would jeopardize the quality of audits because it introduced a potential conflict of interest. In retrospect, that concern was justified. In respect to Enron, Anderson hired the firm's entire team of 40 internal auditors and subsequently engaged in a series of aggressive reporting practice that created friction between the Anderson group responsible for Enron and Anderson's own professional standard group. Ironically, on October 15, 2001, the evening before Enron was due to announce its third quarter earnings, Anderson accountants indicate that they could not approve the financial statement that Enron wished to release. Several weeks later, Enron declared bankruptcy. Next is Sarbanes-Oxley. Fraud is an extreme example of agency conflict where behavior crosses from being unethical to illegal. Since 2000, a succession of corporate scandals with varying degrees of fraud made clear that compensation in the form of stock and stock options could not be counted upon to align the interests of investors and managers. Among the firms involved in fraudulent activities were Coca-Cola, IBM, Sunbeam, Santan, Xerox, Learnout and Haspai, Parmalat, Enron, WorldCom, and HealthSouth. Sarbanes-Oxley, in the wake of this financial scandal, Congress passed the Sarbanes-Oxley Act of 2002. Directly SEC requires that the CEO and CFO of every publicly traded firm certify, under oath and veracity of their firm's financial statement. Example, Health South. First firm charged under Sarbanes-Oxley. The SEC accused Health South executives of having engaged in insider trading. Executives sold substantial amount of Health South stock while they knew that the firm's financial statement grossly misstated its earning and asset. Health South executives. Five former Health South CFOs pled guilty to charges. Health South CEO claimed that he was victim of deception by his CFOs and was acquitted. Government attorneys dismay at failures of first prosecution under Sarbanes-Oxley. Fraud and stock options illustrative example. In theory, granting stock to executives serves to align their interests with those of shareholders. In theory, executive stock options serve to counteract executives' reluctance to accept risky projects that would benefit shareholders. An implicit assumption in traditional theory is that market prices are efficient. In practice, price might be inefficient, and the use of stock and stock options can provide managers with perverse incentives. Indeed, the granting of stock options might serve to induce managers to accept risky projects that features negative net present value. That's all for my part, and the next report will be continue the topic.
Good day, everyone. Before I proceed to my report, please allow me to introduce myself. By the way, my name is Nova Bella Costillas, and today I will be discussing about the internal controls. So, internal controls are the integrations of the activities, plans, attitudes, policies, as well as the efforts of the people of an organizations who working together to provide reasonable assurance that the organizations will achieve its objectives and missions. So internal controls are the integral part of the operating procedures management uses to accomplish its missions and to achieve its goals. An effective system of internal controls can give managers the means to provide accountability for their programs, as well as the means to obtain reasonable assurance that the programs they direct establish goals and objectives. While managers have a significant impact of the organization systems of the internal control, every employee of the organizations has a responsibility and a role in ensuring that the system is effective in achieving the college missions. So another definition of internal control is it is a broad concept. So internal control is everything that control risk to an organization. Internal control is the company's first line of defense against errors and frauds. When you are dealing with business, there are risks that you are willing to pick, so you need to accept it. So I have prepared a photo so that we can fully understand what this definition means. So the internal control is your first line of defense in order to avoid errors and frauds. So you have this tunnel. The first objective of internal control is your first line of defense against errors and frauds. So the dashed line, which is the color orange, is the representations of the internal control. Because of the time, we cannot eliminate the risk, where we can only minimize the risk that enter the company. So what is actually the risk is? So when we are talking about risk, it is the situations that involve exposure to danger. For example, when you are driving a car, what is the risk there? So either you will run over or you will crash. When we are dealing in business transactions, there are risks involved. there are situations that have the possibility of danger. So we are willing to take the risk, but it doesn't mean that we will accept that. We need to enforce internal control so that we can reduce the risk in the organizations, because when there are risks, it will affect our resources. So, what do you mean by errors and frauds? So, when we are talking about errors, this is the mistake, whereas frauds pointing to intentional wrongdoing. So, there are difference in it. So, that is the intent. In fraud, there is intent, but in errors, there is no intent. So, you just made a mistake without knowing it. I added some video information from YouTube about the internal control system, and please take a look at this video.
Life is full of risks. All day, every day, we do things that can go wrong. But thankfully, there are protections in place to make things go right. In business, we call those protections internal controls. Some may call them bottlenecks. But to protect your business and achieve your goals, internal controls are critical. They help detect errors, avoid delays, and prevent negative financial and reputational impact. We use the internationally recognized COSO Internal Controls Framework to guide us in designing and evaluating our internal controls to manage operations, ensure financial reporting is accurate, and to be compliant with applicable regulations and our internal policies and procedures. There are different types of internal controls: preventive and detective, manual and automated. To show how they work, let's use a new loan, for example. To prevent unauthorized loan transactions, we obtain board approval, which is a manual preventive control, and automated preventive controls such as system access restriction and system-triggered approvals when dispersing payments. To find errors or confirm information accuracy, we use manual detective controls such as reviewing analytical data and budget reports, and automated detective controls that reconcile information from system to system. We use a combination of many types of controls to provide the greatest risk detection, correction, and ultimately prevention. We're all responsible for internal controls, but we may play different roles. Senior management sets the control environment. VPs and directors oversee and allocate resources and monitor. Managers create strong controls in their processes and teams. And staff executes the controls and communicates issues to their managers. If you think of your responsibility as a leg on a table, it's easy to understand how our collective participation is critical to our success, and how together we can manage risks.
What is the primary purpose of internal control? So the purpose of internal control is to help safeguard an organization's and further its objectives. Internal control's function is to minimize risk and to protect assets, ensure accuracy of records, promotes operational efficiency, and encourage adherence to policies, rules, regulations, as well as the laws. In order for you not to forget the purpose of internal control, you need to think, or always to think, the word CARES. C stands for compliance with applicable laws and regulations. A stands for accomplishments of the entity's missions, which is the objectives and goals. R stands for relevant and reliable financial reporting, which means data is accurate, timely, useful, reliable, and relevant. E stands for effective and efficient operations. Operations are effective and efficient accomplishments and monitoring of goals. S stands for safeguarding of assets. Safeguarding assets, which means assets are protected from theft, misuse, and or distractions. All in all, internal controls are intended to prevent errors and irregularities, identify problems, and ensures that corrective action is taken. So now, let's talk about who are the responsible for internal control. So everyone in an organization has a responsibility for internal control. The senior management sets the tone at the top that affects the integrity, ethics, and other factors of a positive control environment. So senior management is responsible for establishing the control environment and communication systems within the organizations. These two components provide executive management with the greatest opportunity to positively impact internal control. Management is responsible for establishing and maintaining the control environment. Auditors plays a role in the system of internal control by performing evaluations and making recommendations for improved controls. Furthermore, every employee plays a role in either strengthening or weakening the institution's internal control system. Therefore, all employees need to be aware of the concept and purpose of internal controls. Remember, if you are at the staff level positions and you know there is a problem, bring it to your management's attentions. If you are at top management level positions and you are aware of a problem, then as the management, you are responsible for correcting the issue. There are 5 main components of an internal control system. First is the control environment. It sets the tone for the organizations and influencing the control consciousness of its people. It is the foundations of all other components of internal control. The key elements of the control environments include missions, ethics and integrity, competence, and supportive attitudes. Risks are the events that threaten the accomplishments of our objectives, such as human errors, frauds, system breakdowns, and natural disasters. In the risk assessment process, we identify each risk in terms of likelihood, significance impact, and cost. Control activities includes policies and procedures, documentations, and authorizations. In monitoring, it assessed internal control performances. While in communications and informations, the relevant informations must be available and must occur up, down, and across an organizations. For example, our missions. What are the expectations for our employees? A means for employees to provide suggestion for improvement or to report the suspected ethical violations. To fully understand about the 5 components of internal control, please take a look at this video.
In order to complete your SOC 1 audit, you have to have the components of internal control in place and functioning. And these 5 components are known by the acronym CRIME. The C stands for control environment. How has management put into place policies and procedures that guide the organization? What kind of tone has management set in the organization so that everyone knows that we are supposed to make sure that our controls are operating effectively and achieving the results that we expect? The R is risk assessment. How does the organization assess risk in order to identify the things that threaten the achievement of our objectives? The I stands for information and communication. How does management communicate to our internal and our external users what it is we expect from them, and how do we make sure that we receive acknowledgement from those people that they understand what it is that we're asking them to do? The M is monitoring activities. How does management oversee the functioning of the entire organization, and how do we identify when things aren't working correctly and correct those deficiencies as quickly as we possibly can? And then the E stands for existing control activities. This is the largest section in your SOC 1 report because it talks about all of the controls that you've put into place and how the auditor tested those controls to make sure that they were operating effectively over a period of time.
Let's talk about behavioral pitfalls. Behavioral Pitfalls Health South was founded in 1984. At the year end of 2001, Health South is one of the United States' largest public healthcare companies. It specializes in medical rehabilitations and outpatient surgery service. It's operated in approximately 1,900 locations in the United States, United Kingdom, Puerto Rico, Australia, Canada, and Saudi Arabia. So what happened to Health South fraud? Health South was caught for feeding their accounts. They falsely inflated its profit margins to meet Wall Street's expectations. By the end, the company has added at least $1.4 billion to non-existing earnings to its profits. To fully understand what happened to Health South fraud, I added a video presentations and please take a look. So let's proceed to ethics and cheating. So deliberately engaging in accounting fraud is both illegal and unethical. Unethical issues like the heart of many principal agents conflicts, as the Health South case makes clear. So what is cheating? The simplest and most immediate answer is that cheating is breaking the rules. For example, not reporting income on one's taxes, buying clothing with the intention of wearing it once and returning it, stealing from one's employer, or copying others for exam. But the simplest answer doesn't paint the full picture. Cheating, misconduct, deceptions, and other forms of unethical behavior are widespread today. not just in business, but it also in sports, governments, schools, and many other arenas. Research suggests that most of us would behave unethically, to some extent, under the right of set of circumstances. Dishonesty is an overt social behaviors that requires audience to exist. Compared to cheating, dishonest acts requires knowingly fabricating false informations intended to deceive an anticipated audience. While the media often focus on extreme cases of cheating and sensational scams like health outs frauds, less attention is paid to what researchers calls ordinary unethical behavior. Defined as unethical actions committed by people who have value and care about morality but behave unethically when faced with an opportunity to cheat. The commonplace violations of ethics are often the results of people giving it into the temptations to cheat when confronted with the opportunity to do so, and can be motivated by selfish, pro-organizational, or altruistic reasons. In aggregate, these behaviors are extremely costly for both businesses and society. Understanding how these behaviors are enabled and how to mitigate them can be valuable. Why students cheat? The Josephson study indicated that the drive towards academic excellence has become a negative excuse for cheating. The cheat suffers harms as well as from cheating. The students who cheats does not learn anything from cheating, except for how to cheat and perhaps how to cheat successfully. This is not likely to produce a true friends, admirers, as well as the supporters. It is not likely to produce a person who has acquired knowledge that enriches a person, expands their horizons, broadens their experiences, and develops their abilities. In cheating, the cheater aids and abets the practice, continues its popularity and spread. Ethics and psychology. Why people cheat. The Josephson Institute makes clear that the most people are predisposed to cheat. The evidence shows that when people are provided with an environment featuring the illusions of anonymity, thereby inducing them to think that they are less likely to be caught, then they cheat more. The cheater will probably complain throughout life of being the victim of cheating, of those who cheat in billing, weighing produce, misrepresenting products, and business agreements. In the very simplest terms, cheating is a bad thing to do. Don't do it, don't harm others, and do not harm yourself. That's all my report, and thank you for listening.